Hi there, I'm Rob Bertman, founder of Money with Impact, and today's topic is, should I be contributing to my retirement plan? Now, if you've heard other financial advisors or experts out there, they would all recommend, yes, contribute to these retirement plans, do it as much as possible and as often as possible. But is that really good advice? Is that really good advice for you? Has anyone ever asked the question, should I be contributing to my retirement plan? And if so, how should I do it? And that's what I'm going to cover today. And I'm actually going to tell you one of the number one mistakes I've seen people make when they decide to contribute to their retirement plans. But before we get into that, I want to take a step back and let's talk about what exactly this is and how they work. Now, maybe you've heard of retirement plans referred to as a 401k plan, a 403b, IRA, Roth IRA, rollover IRA, SEP IRA. There's any number of shapes and sizes of retirement accounts, but they basically all work like this. You put money into an account, and there's certain limits that you can put in, and there's a certain amount of money, income limits, that how this works too. But you put money into this account, and in the year that you put the money in, typically you can take a tax deduction against the amount of money that you put in. Once it's in the account, it grows over time. And as it grows, you don't have to pay any taxes. You don't have to pay any capital gains or income taxes on the growth of that. So it grows tax-free, which is a great benefit. That's, to me, the best benefit of a retirement plan. And then when you take out the money, when you're 60 years old or so, you pay taxes on it when you take the money out. You pay taxes on the amount that you take out. Now, a Roth IRA or a Roth 401k works just slightly differently, same concept, but instead you're not able to take that deduction on taxes up front. It still grows tax-free, but on the end, when you take out the money, you don't owe any taxes on it. So that's really how these work. And whether you work for a company or whether you're self-employed, there are a number of different retirement plan options available. Now, one of the other big benefits is that companies often have what's called a matching program, where if you put a certain dollar amount into these retirement plans, they will put in extra money on top of your contribution. So that's great. And often these work either dollar for dollar, or they work every dollar you put in, the company will put in 50 cents. So for example, let's say someone puts $2,000 into their 401k plan and their company has a matching program. They put in $2,000 and the company that they work for will put in extra $1,000 on top of that. That's like free money. So you can see there are great benefits to saving in retirement plans or retirement accounts. You get the tax benefit, and also if your company offers it and if it's the right type of account, you get that matching program. But there's a trade-off for that. And the trade-off is this money, you really can't touch it except under certain circumstances unless you pay a penalty until you're 60 years old. And that's great, but that's, you're paying a price for that and you're getting this benefit. So it works out okay. But the number one mistake I've seen people make is that they don't take into account their other financial goals when deciding how much to put into a retirement plan. Now, let me give you an example of how that might work. Let's say someone has financial goals. Obviously, they want to retire or have financial independence down the road, but they also want to buy a house, or maybe they want to start a business or buy a business. And this person, over time, they've accumulated $100,000 in their retirement account, which is a nice amount of money. And they also have $5,000 in a savings account, which is, that's not bad either. But they're also 30 years old, and they have 30 years until they can touch that $100,000 in those retirement accounts. So if they want to buy a house, if they want to start a business, if they're going to take a hit on income so that they can build their business up, the only thing that they have to work with is that $5,000 in their savings. So now when they turn 60, it's going to be great. They're going to have these retirement assets available to them. So the solution to this is really, one is I don't look at these things as retirement plans because, in 25 years or so when I turn 60, I don't know if I'm going to be retired or if I'm going to want to retire at that point. And so I don't look at this necessarily as a retirement plan as much as I look at it as this is money I can use when I'm 60 years old or older. So I call this my 60 plus money. Any money that's saved in an IRA or a Roth or a 401k or whatever, that's my 60 plus money that I can use when I'm that age. But I also have financial goals. And so what we're doing is saving in these different buckets, and we're trying to get there as efficiently as possible. So number one is look at it in terms of that. This is money you can touch when you're 60 years old. Number two, if your company offers a matching program, that's like free money. That's like your company giving you a raise or extra money. So it's probably a good idea to take advantage of that in some way, shape, or form. But also, go through your goal setting process and say, what do I want to accomplish before I turn 60? And then you have to dedicate savings to those different goals along the way, whether it's buying a house, starting a business, maybe paying off some debt. You have all this money and then you put these into certain accounts or certain savings accounts that will get you there as efficiently as possible. Now again, retirement accounts have a great benefit. You get the tax deductions, you get the tax-free growth along the way and all that, and that's wonderful. But you also need to balance it with the flexibility that you want in your life over the next 30 years. So I hope this is helpful to you. If you need help figuring out what your financial goals are, I did a blog a while back called Financial Goals Are Boring. So you can check that out to have an exercise that will take you through uncovering what your real financial goals are. Or also, if you go to moneywithimpact.com, I have a blueprint that you can download which will walk you through a way that you can maximize your money and figure out where you can put your money, how you should be spending your money in a way that's going to get you the things you want out of life today, but also set you up for tomorrow. So, and as always, please connect with me. Please ask me questions. You can connect with me on Instagram, Facebook, Twitter, etc., LinkedIn, or you can send me an email at rob@moneywithimpact.com. And please, ask me questions. I'm here to help you on this journey. So thanks again for taking the time. I greatly appreciate it, and I look forward to talking to you soon. Thanks.